Hello traders, welcome back to the Forex Gig where we dive deep into the tool that can help you make smarter trading decisions. And in today's video, we're going to be talking about a simple scalping strategy that can help you take advantage of quick price movement in the Forex market. Whether you're a beginner looking for an easy to go follow approach or an experienced trader seeking to refine your technique, this strategy is designed to deliver consistent results. So why not stay with me until the end of this video, as I will be breaking down each step you will need to know how to implement in this strategy effectively, and you start seeing results in your trading. We start by understanding what scalping is, and scalping is a short-term trading style that focuses on capturing small price movements within the market, the forex market. It involves entering and exiting trades quickly, often within minutes, to take advantage of mi minor fluctuations in price, unlike long-term strategies such as your swing or position trading strategy. Your scalping is all about precision and speed. So there are some key features we'll be looking at about scalping. The first feature will be your time frame. Scalpers typically use short time frames such as your 1 minute or your 5 minutes chart to analyze price action. So if you are to scalp, you either use your 5 minutes or your 1 minute. The second feature would be your trade frequency. The scalping requires frequent trades throughout your trading section, offering often targeting a high liquidity period. Now the third feature would be your market condition. This strategy works best in a volatile market where price movement occurs rapidly. Why do scalping work? Scalping is effective because it focuses on small opportunities that occur frequently. They occur frequently during the day. Instead of waiting for large moves, scalpers aim to capitalize on quick reaction to market conditions such as breakout or retracement. So this style is very easy to note, and you can see we are on the 1 minute. Even if you are making use of your ranging market, your range breakout, once you spot a breakout from the range on your 1 minute and you decide to capitalize on this trade, as a scalper you will know you are just making use of quick in and out moves from the market. This is all you need to know. This trading strategy demands discipline and focus. Scalpers must be able to make quick decisions based on clear entries and exit criteria. While managing risks effectively, it is not about predicting your long-term trend but rather responding immediately to price action. So let's see how we can implement our trading strategy on a live chart. All we need to do is, first of all, we just apply the two major indicators we'll be making use of on this strategy. The first indicator is your exponential moving average, and your second indicator will be a momentum confirmation indicator known as your stochastic oscillator. This is designed to provide a clear entry and exit signal for clear and quick trades. So let's start from the step one. It will be to set up your chart. How do you set up your chart? You set up your chart by trading the major currency pairs with tight spread. Remember, spread is also something you need to consider when trading as a scalper, because you cannot be trading in a widespread conditions. So you have to trade the major forex pairs with small spread, such as your euro USD, your GBP USD, your AUD USD, and so on and so forth. So when you set your chart, Like in my example, I'm setting my chart to our GBP USD. We set our time frame to your 1 minute time frame, and you apply your exponential moving average. You set a length of 50 and 100 for your exponential moving average, meaning that we are using 50 period exponential moving average and your 100 period exponential moving average. In addition to that, we would apply our stochastic oscillator, and we will use a setting of 533. 533 is a setting for scalping. This would help us capitalize on smaller movements on the chart. The second step would be to identify your entry signals. Remember, for a long position, you expect your 50 EMA to cross above your 100 EMA. Remember, the 50 EMA is this blue line. Once the blue line crosses above the yellow line, this signals a buying opportunity. Then finally, you would have to check your stochastic oscillator to see if it is rising above the 20 level. At this area where we saw our crossover, you confirm with your stochastic oscillator if it's rising above the 20 level. As you can see, it is rising above. This is the 40 level, and so on and so forth. This confirms our upward momentum. Now, in terms of a selling trade or a short trade, the process is reversed. All you need to do will be to check if your 50 period exponential moving average crosses below your 100 period exponential moving average. This indicates a bearish trend. You also have to check if price should be near both EMA, and the stochastic oscillator should fall below 80, and at this area you can see that it is falling below 80 after your crossover. This is trading below 80, signaling the downward momentum. The third step would be your trade execution. How do you execute your trade? You enter immediately after all conditions are met. So at this area where we saw our crossover, we notice our stochastic oscillator is trading above 20, and we saw our crossover. We can enter the trade the moment we see price has come back to the exponential moving average. You enter your trade at that area and you set your stop loss. Remember, to manage your risks effectively, you have to set your stop loss 2 to 3 pips below the recent or the last swing low in terms of a long trade. And in a sell trade, after your crossover, you can enter your position when you notice price has come to retest the trend line. You aim for you place your stop loss just above the most recent swing high in a sell trade. This is how you manage your stop loss. Remember, your target should be a reasonable distance. You can target around 8 to 12 pips away from your entry. 8 to 12 pips away from your entry, because we are scalping in this strategy. Since we are scalping, 8 to 10 pips, 8 to 12 pips away from your entry will be a quick move, and as you can see from the chart, these are quick moves in and out of the market, and they ended up giving us 1:2, 1:2. This is how you have to execute your trade. Remember, your trade, once all conditions are met, you use your market order to execute your trade immediately, as timing is crucial in scalping. This is your step 4. Remember, timing is crucial. The moment all your conditions are met, you would execute your trade immediately. Consider using a one-click trading functionality if available to streamline your process. Now, the fifth step is exit strategy. You will exit your trade when it reach your target, or when the stochastic oscillator cross back in the opposite direction. Meaning, in a buy trade, once you notice the oscillator has gone back to below 20, you can exit your trade. And in a long position, you can exit your trade the moment you notice price has gone back to your 80 region, which is overbought region. This is how This should be the condition where you will decide to exit your trade. You can decide to put your stop loss above your entry and consider using a trailing stop to maximize your po ten tial gains. Alright traders, we have come to the end of this video. Engage with us in the comments below. We want to hear about your experiences. And if you found this video helpful, do not forget to like, share and subscribe. Turn on your notification bell so that you never miss out on more trading tips and strategies. Thank you for watching, and I will see you in the next video.